Welcome to the deep dive. Let's challenge a really common misconception right off the bat. When you hear life insurance, what often comes to mind? Probably a stack of bureaucratic paperwork, lots of confusing jargon, maybe even a feeling of dread. But what if I told you it's far more than just, a necessary evil? It's actually a powerful financial instrument. It has profound implications for everything from protecting your wealth and planning across generations to even influencing national savings behavior.
That's absolutely true. It's much, much deeper than just a checkbox on a financial plan. So our mission today is to take a proper deep dive into Germany's incredibly unique and, well, highly regulated life insurance market. We're drawing our core insights from Dr. Pooyan Ghamari's Life Insurance in Germany, a strategic guide, which really unpacks this complex landscape with amazing clarity. The goal here is to equip you, our listener, with a framework for critical thinking, so you can make truly rational decisions in what can otherwise feel like a very opaque financial space.
And Germany specifically, it offers such a fascinating lens for this. I mean, it stands as the world's third largest insurance market, right after the US and Japan. And this isn't just about sheer size. It really speaks to a deep cultural emphasis on financial security. Insurance penetration is exceptionally high there. It's seen as a cornerstone of financial well-being, right alongside, homeownership and robust pension savings. It's sort of woven into the fabric of German financial.
Precisely. And this deep historical reliance, it really forms the foundation of what we see today. For decades, German families heavily leaned on something called Kapitallebensversicherung, capital life insurance. This wasn't just a death benefit. It was a kind of hybrid product. It guaranteed both death protection and a savings component. It often ended up serving as a sort of quasi-pension.
Yes, it is essentially the bedrock of their long-term financial planning, providing this very tangible sense of security. Okay, let's unpack this, because here's where the story gets really interesting. That deeply entrenched historical foundation, it collided head-on with a massive economic shift over the last decade or so. We're talking about the European Central Bank's prolonged low interest rate policy. How did this fundamental shift in monetary policy effectively, destroy the business model of these guaranteed products?
It's such a stark example of how insurance just cannot escape the broader monetary policy environment. It really can't. The traditional Kapitallebensversicherung model was built on this premise of stable, attractive interest rates, guaranteeing returns of, say, 3% to 4%. Then the ECB drove rates down, way down. And those guarantees, which were once the big selling point, they became crippling liabilities for insurers. What once yielded 4% now struggles to even get past 1%. So this exposed a profound structural flaw. Guarantees without yield become an unsustainable burden for the insurer, yes, but also, ironically, for the policyholder whose purchasing power just erodes.
That's a powerful shift, a really fundamental break. So if the old model was fundamentally broken by this economic reality, what innovations did German insurers have to embrace to adapt? What new financial instruments emerged from this, necessity?
Well, what's fascinating is how this crisis really spurred innovation. German insurers couldn't just sit there. They were compelled, really, to develop new products like Fondsgebundene or fund-linked, and also index-based policies. These represent a significant departure. They embrace market-driven instruments that allow policyholders to actually participate in the capital market. So the landscape today is this compelling blend of tradition and transformation. You have these modern, dynamic products now coexisting with the security-oriented, albeit less profitable, options from the past.
Okay. Having set the stage with Germany's unique economic shifts and this transformation, let's now arm ourselves with the practical knowledge. Let's walk through the distinct categories of life insurance products available, from the most basic to the most complex innovations. We'll start with the simplest and arguably the most rational form, Lebensversicherung, pure protection, or what we often call term life insurance.
Yeah, the true genius of Lebensversicherung isn't just its cost-effectiveness, though that's part of it. It's its stark clarity. It acts as a highly efficient actuarial firewall, you could say. It isolates the pure cost of mortality risk without all the noise of investment. For those familiar, this product simply provides a death benefit for a defined period. If the insured person passes away within that term, the beneficiaries get the sum. If not, the contract just expires. No residual value. It's a pure cost, definitely not an investment vehicle.
So who truly stands to gain most from such a focused, pure protection product in Germany today, and what specific scenarios make it the optimal choice, especially when we consider, as you said, its low cost relative to coverage?
That's a great question because its power really lies in its laser focus. For young families, particularly those maybe with a mortgage or single-income households, it's almost a non-negotiable safety net. Imagine a family who just bought their first home Fondsgebundene Lebensversicherung ensures that if the unthinkable happens, the home stays debt-free for the survivors. That's huge. It's also crucial for entrepreneurs or small business owners who've taken on loans. It provides a clear path to protect their business and personal assets from, well, unexpected tragedy. It effectively transforms an uncertain, potentially catastrophic loss into a predictable, manageable premium. It's like a surgical tool for targeted protection. And often it's a more rational choice in a low-yield world than products trying to do two jobs badly at once.
Okay, so if Risikolebensversicherung represents clarity and focus, our next product, Kapitallebensversicherung, is its more complex, historically entrenched cousin. This is the traditional security with a catch product, as you put it. Tell us more about its historical dominance. Why did it become so deeply embedded in the German financial psyche?
Well, for decades, it really was the all-in-one powerhouse. Savings and protection bundled together. This traditional German model combined death protection with a savings element that offered guaranteed minimum returns. Back in the 1980s and 1990s, these were immensely popular because those guaranteed returns, often 3% to 4%, they comfortably outpaced inflation and had attractive tax advantages too. So the appeal was simple. A guaranteed return backed by a solid insurance company plus peace of mind. What's not to like, right? Back then.
That sounds appealing on paper, I get it, particularly for risk-averse savers. But today, as you mentioned, the story is very different. What are the significant drawbacks that make this product a catch in the current economic climate? And what opportunity costs does it really present for policyholders now?
Right. And the fact that Kapitallebensversicherung still has some popularity, albeit diminished, it reveals a fascinating cultural insight. The German psyche often seems to prioritize the tangible comfort of a guarantee, however meager it is now, over the potential for higher but uncertain market returns. It's a sort of deeply embedded behavioral bias that financial innovation is constantly bumping up against. But the drawbacks today are indeed significant. You've got poor returns in this low-interest environment with guarantees basically close to zero. You have long lock-in periods with very limited flexibility, and often high or quite opaque fee structures that just eat away at what little return there is. Economically speaking, these policies perfectly illustrate that trade-off between perceived security and, frankly, significant opportunity cost. Locking your capital into low-yield guaranteed products like this risks serious erosion of purchasing power over time. That's a critical consideration, especially for professionals who understand the time value of money.
Okay, so if Kapitallebensversicherung was the old answer to managing both risk and savings, the new answer, born from that necessity we discussed, is Fondsgebundene Lebensversicherung. Fund-linked life insurance. This is the product that genuinely links to the market. How does it manage to bypass that low-yield trap that ensnared its predecessor?
It tackles the low-yield problem head-on, really. Instead of offering guaranteed returns, the savings portion of these policies gets invested directly into mutual funds. This allows the policyholder to actually participate in the capital markets, equities, bonds, whatever the funds hold, while still maintaining that essential death protection component. So it essentially offers an insurance wrapper, kind of like a tax-advantaged shell, around a diversified investment portfolio.
And this sounds like a strong fit for a particular type of investor or saver. Who stands to gain the most from this product, and what specific advantages does it offer, especially thinking about professionals seeking maybe tax-optimized investment vehicles?
It's certainly attractive to, say, younger policyholders with long investment horizons. They simply have more time to ride out market volatility. It's also ideal for investors who are willing to accept that volatility in exchange for potentially higher returns. And for professionals, yes, it offers direct access to equity markets within a potentially tax-advantaged insurance framework. Some of these policies can offer certain tax benefits on long-term holdings, for example, on withdrawals during retirement, which can be a significant draw. Of course, the flip side is clear. There's no guaranteed return. Market volatility can definitely reduce the final payout. And the complexity in fees, just like with any managed fund, can erode net returns if you're not careful.
So from an economic perspective, what's the critical question a professional should ask themselves when considering a Fondsgebundene Lebensversicherung compared to just, investing directly in funds themselves? Where does that insurance wrapper truly add value?
That really is the crux of it. This product is much closer to a hybrid part investment fund, part insurance contract. So its success hinges less on the insurer's guarantees and much more on global equity markets and the performance of the specific funds you choose within the policy. For a professional, the critical question has to be, Does that insurance wrapper, with its potential tax benefits and the death benefit component, genuinely justify its costs compared to simply investing directly in a low-cost, diversified portfolio of ETFs or mutual funds? It boils down to a calculation of net expected return versus the value you place on that added insurance structure and potential tax shield.
Right. Beyond these, we have newer models emerging, things like index-linked and universal life models. How do these innovative structures differ, and what strategic advantages might they offer, especially for folks who need a bit more flexibility in their financial planning?
Yeah, these models represent further evolution, trying to find that sweet spot. Index-linked products are designed to tie the savings component to broad market indices, like the DAX or the Euro Stoxx 50. They often offer capped participation in market growth, meaning you benefit from upside, but only up to a certain limit. Crucially, they often come with mechanisms to avoid direct losses, providing a degree of capital preservation, which appeals to that security focus again. Universal life, while still more common in the US, is slowly gaining traction in Germany. It's generally known for greater cost transparency, flexible premiums you can often adjust how much you pay in, and adjustable death benefits, allowing policyholders to adapt the policy as their life circumstances change.
So, for someone like an entrepreneur with maybe fluctuating income or an investor who wants more control over their contributions, these models could be quite attractive. But as with all structured products, you're emphasizing the need to really scrutinize the transparency of fees and those caps on growth, right? That seems key.
Absolutely. The devil is always in the details with these more sophisticated products. You need to understand exactly how much you're paying in fees, explicit and implicit, and what limits, those caps or participation rates, are placed on your market participation. Then, shifting gears a bit, we have a much smaller but incredibly practical product. Versicherung. This is essentially funeral cost insurance.
Yeah, the source points out that German funerals can easily run 7,000 to 10,000, sometimes more. That's a significant chunk of money to find quickly. Who truly benefits from this very specific type of insurance, and what's its economic role in overall financial planning?
Well, this is primarily aimed at elderly individuals who might not have significant liquid savings readily available, and certainly for families looking to relieve their children of that immediate financial burden of funeral costs right after a loss. It avoids them having to dip into potentially illiquid assets or savings. From an economic perspective, this is less about investment growth and much more about incredibly practical cost planning for a specific inevitable expense. For wealthier households, maybe simply earmarking liquid funds or setting up a small trust might be more efficient than locking premiums into these contracts over many years. But for others, it's a profound act of, well, dignity planning.
Okay. And finally, we have a whole category of pension-oriented insurance products. The context here is critical, as you touched on earlier. Germany's widening pension gap, it's driven by demographics, fewer workers financing a growing number of retirees. This dynamic has clearly fueled demand for these kinds of products.
Indeed. We're talking about a major national challenge here, and these products are part of the proposed solution. This category includes things like Riester-Rente, which is state-subsidized, but frankly, can be quite complex in its structure and is often criticized for its overall efficiency and cost. Then there's Rente, which is particularly attractive for the self-employed because of its significant tax deductibility on contributions, and also private Rentenversicherung, which is essentially a private pension plan offering flexible long-term savings, often with optional death protection built in or added on. The key insight here, I think, is that these aren't pure insurance in the traditional sense of just covering a risk. They are a vital part of Germany's national effort to try and bridge those looming pension deficits through private capital accumulation. They represent a blend of individual savings initiative and a strategic societal response to these big demographic shifts.
So with this really diverse array of options, what's the strategic playbook? How does Dr. Ghamari's framework help you, our listener, make a rational decision? Because clearly, there's no single one-size-fits-all product here.
That's exactly right. It truly boils down to aligning the product with your specific life stage, your risk appetite, and your financial goals. It's very personal. So, for example, for that young family with a mortgage we mentioned, Lebensversicherung Term Life is almost certainly the best bet. Maximum protection per euro spent. It ensures the debt is covered, the family keeps their home. Simple, efficient.
And what about that professional who might be inherently risk-averse, wants that feeling of security, but maybe still wants to engage with the market somehow, or someone just planning for their final expenses?
Okay, for the risk-averse professional, Kapitallebensversicherung might still hold a certain psychological appeal due to its predictability, but honestly, it must be approached with significant caution today. You have to acknowledge the extremely low returns and opportunity cost. For entrepreneurs and long-term investors willing to take on market risk, Fondsgebundene, or perhaps index-linked policies, offer that market exposure, potentially within an insurance tax shield, which can be highly advantageous over the long run. And for a retiree planning their burial, Versicherung provides that clear, practical path to relieve heirs of an immediate liquidity burden. It offers peace of mind for a specific need. And if you happen to be self-employed in Germany, what's the strategic play there, especially given that pension gap issue? For the self-employed, a Rente, potentially with an insurance add-on like disability cover, is often the most strategic choice. It offers those significant tax deductions on contributions now, plus a robust framework for long-term pension security later. It directly addresses that wider demographic challenge we discussed from an individual perspective.
It's crucial to remember, isn't it, that life insurance isn't just a personal choice floating in a vacuum. It reflects these broader macroeconomic structures. Like the ECB's prolonged low-rate environment, you said it destroyed the business model of guaranteed products. Insurance simply cannot escape monetary policy.
That's a huge point, absolutely fundamental. And then there's demographics. Germany's aging society isn't just a statistic on a page. It directly increases demand for these pension-oriented products while simultaneously reducing the efficiency of those traditional state pay-as-you-go systems. So here, life insurance, particularly these pension products, becomes a critical bridge between generations. It's a way for private capital to help shore up a national challenge.
And finally, that fascinating insight from behavioral economics you mentioned earlier, Germans often value security over return, even if it means sacrificing financial efficiency. This helps explain why Kapitallebensversicherungen still attract some clients despite their poor yields today. Understanding this psychology is really key for professionals trying to advise clients rationally.
It really is. You have to meet people where they are, psychologically, while still presenting the economic realities.
So what does this all mean for you listening right now? The core lesson here, I think, is that there is no single best life insurance product in Germany. There just isn't. The optimal choice is always about aligning risk, return, and your time horizon with your specific personal and professional realities.
Exactly. For a young family, it's probably inexpensive term insurance. For a seasoned entrepreneur, maybe fund-linked products serve as both protection and a tax-optimized investment vehicle. For the elderly, a modest burial insurance policy can be a completely rational form of dignity planning. It's about finding the right tool for the job. It's a strategic economic contract you make with your future self or your family's future.
And that's the truly profound thought to leave you with, echoing Dr. Ghamari's insights. Insurance is not an accessory, it is an economic contract with the future. Its true value depends less on the product's flashy promises and more on how you, as an individual, integrate it into a coherent, thoughtful financial strategy. Definitely something to really consider as you plan your own financial future.